Are you ready to take control of your trading and unlock the secret to consistent profits? In this course, we're going to dive deep into the heart of what makes or breaks a trader: trading psychology. Most traders focus on strategies, indicators, and market analysis, but they overlook the most powerful tool in their arsenal: their mind. Over the next 40 minutes, you're going to uncover the psychological edge that can transform your trading results. We'll talk about how emotions like fear and greed can impact your decisions, and how mastering your mindset can help you stay calm and objective, even in the face of market volatility. But we won't stop there. We'll cover essential topics that many traders fail to understand fully, but that are crucial for long-term success. Master your emotions to avoid overtrading. Overtrading is one of the biggest traps for traders. We'll explore why emotions like fear and greed often drive overtrading, and how you can control them to preserve your capital and make smarter decisions. The real edge of trading. Psychology. Trading isn't just about executing orders. It's about understanding why you act the way you do in the market. We'll take a deeper look at the psychology behind trading success and how it influences every decision you make. How to avoid common trading mistakes. The most experienced traders make mistakes, but the key is recognizing them and learning how to avoid them. In this section, we'll identify common mistakes and, more importantly, how to avoid them with the right mindset. Overcoming the fear of trading. Fear is inevitable, but it doesn't have to control you. We'll explore how fear affects your trading behavior and how to overcome it so you can trade with confidence, not hesitation. Lessons from the greats, the psychology of the world's best traders. What if you could learn from the minds of trading legends like Soros and Livermore? We'll discuss the trading psychology that helped them rise to the top and how you can apply it to your own approach. Building a winning trader's mindset. Your mindset is everything. In this section, we'll talk about how to create the mindset of a successful trader, no matter your experience level. Mastering discipline in trading. Without discipline, even the best strategy will fail. We'll explore the importance of discipline and how it can protect you from impulsive decisions and devastating losses. By the end of this course, you'll have a clear understanding of how psychology directly influences your trading success. This isn't just about what to trade, but how to approach the markets mentally. Whether you're a beginner or an experienced trader, mastering your trading psychology is the game changer that could propel you towards consistent success. Are you ready to unlock your true potential? Let's dive in. The role of emotions in Forex trading. How to control your mindset and avoid overtrading. What if I told you that the real reason you're losing trades isn't the market, but your emotions? In Forex trading, it's not just about analyzing charts or finding the perfect entry. It's about mastering your mindset. The stock market is filled with individuals who know the price of everything, but the value of nothing, said Philip Fisher. And that's the truth. Your emotions can either make or break your trades. In this video, we'll uncover how controlling your emotions is the secret to unlocking consistent profits and transforming your trading mindset. Chapter 1. The Hidden Force in Trading. Trading isn't just about numbers, it's about your mindset. In the next few minutes, you'll discover the hidden force that's sabotaging your trades right now, your emotions, and how to take control of them so they never take control of you. Chapter 2. The Impact of Emotions. Every trader faces this battle: fear, greed, anxiety. These emotions are the silent killers of profits. But here's the truth. Emotional chaos can make you lose it all, or it can unlock your true potential. The difference? How you manage them. Chapter 3. Overtrading, the Trap. You can't afford to fall into ever jumped into a trade just to make up for a loss. Or doubled down because you felt like you had to act. That's overtrading. Driven by emotions like fear of missing out, desperation to recover, or just pure impulse, it's a dangerous game that leaves you drained and frustrated. Chapter 4. The Power of Emotional Mastery. Now, let's talk about the real power of emotional mastery. It's not about avoiding emotions altogether, but about managing them so they don't control your actions. Here's the thing. You will always face tough moments in trading, whether it's a losing streak or watching the market move against you. The question is, how do you respond? Picture this. You've just faced a significant loss. The first reaction might be frustration, anger, or even fear that you'll lose more. But in those moments, you need to pause. Take a deep breath. Why? Because emotional responses cloud judgment. They push you to act impulsively, like jumping into a trade out of desperation or trying to recover losses too quickly. The secret to success isn't rushing to fix things, it's knowing when to wait. By waiting and allowing yourself to regain composure, you give yourself the best chance to make rational decisions. It's about patience and discipline. A disciplined trader knows that one trade won't make or break them. They know that the market will always offer opportunities, but only when they're ready to seize them with a calm mind. So, take a moment and ask yourself, am I reacting out of emotion, or am I sticking to my plan? The greatest traders understand. Success comes from controlling emotions, not from avoiding them. Chapter 5. Building your emotional trading plan. Now that we understand the importance of emotional mastery, let's talk about how to build a solid emotional trading plan. Because, without it, you're setting yourself up for failure. When you create a trading plan, it's not just about market analysis, entry points, and exit strategies. You must also include emotional rules. A good plan prepares you for the psychological battles you'll face along the way. Here's how to start. 1. Define your risk tolerance. Know how much you're willing to lose on each trade. This is the foundation of emotional control. If you're risking too much, emotions like fear and greed will creep in, forcing you to make decisions you'll later regret. Set limits on each trade so you never feel overwhelmed. 2. Create a set of rules for when to step away. What do you do when a loss hits you hard? Step away from the screen. Don't make another trade out of frustration. Give yourself time to reset emotionally. If you're feeling stressed or reactive, walk away. A calm trader is a successful trader. 3. Predefine your reaction to market fluctuations. The market will move against you, and that's inevitable. But how will you handle it? Will you panic, or will you follow your rules and trust the process? Decide before you start trading how you will react when your trades aren't going as planned. Create clear emotional responses to different market conditions. 4. Keep a trading journal with emotions in mind. One of the most powerful tools for emotional growth is reflection. After each trade, record not only the numbers, but also how you felt during that trade. Were you stressed? Were you overly confident? Write it down. Understanding your emotional patterns will help you pinpoint where you need to adjust your mindset in future trades. 5. Reassess regularly. Your emotional plan isn't static. It should evolve. As you grow as a trader, so will your emotional response to different situations. Review your plan periodically and refine it. Make sure it stays aligned with your goals and trading experience. Chapter 6. Conclusion and Call to Action. If you're ready to stop being ruled by your emotions and start making decisions that drive real success, then it's time to master your mindset. Control your emotions, control your profits. This is your moment. Take the step toward the disciplined trader you're meant to be. Start now. management, the secret to consistent profits. The first strategy we're going to explore is risk management, one of the secrets that every successful trader swears by. The key is to always risk 1% of your total capital per trade. Here's how it works. If your account balance is $5,000 and your stop loss is 30 pips, you should use a lot size of 0.17, which results in $50 risk. Then target a 2-to-1 risk to reward ratio, meaning your take profit target should be 60 pips, or $100 profit. By sticking to this strategy, you protect your capital and consistently aim for a 2% return per trade. This is the kind of strategy that works for profitable traders. Protect your capital and maximize your returns. Strategy 2. The simple setup with 60% back-tested results, 60% success rate. Next up, we have one of the simplest setups with a 60% success rate, and it's based on the retest strategy on the M15 or M30 timeframes. Here's how it works. If the market is bullish, we wait for the last low to be retested for a buy setup. If the market is bearish, we wait for the last high to be retested for a sell setup. Pro tip: the strategy works best when the retest happens for the first time. I avoid trades after the second or third touch, as the market is more likely to break the level instead of bouncing. Momentum is another key factor. For a buy setup, look for strong momentum below the last low, and for a sell setup, make sure there's strong momentum above the last high. Strategy 3. Master 1 setup, the secret to success. Finally, the big secret to Forex success. Master just one setup and stick to it. This is where many traders go wrong, trying to use multiple strategies like support resistance, RSI divergence, Fibonacci retracements, and moving averages all at once. Here's the thing: successful traders focus on just one strategy. They know when it works, and they know when it fails. By mastering a single approach, you'll avoid confusing signals and become more consistent. So, whether you use Strategy 1, Risk Management, or Strategy 2, Retest Setup, you'll be successful only if your risk-to-reward ratio is 1-to-2 and you stick to one proven setup. The conclusion: 3. Master one setup and stick with it. Don't mix too many strategies. By following these strategies, you'll be on your way to consistent profits in 2025. Remember, Forex trading is about discipline, patience, and knowing when to trade. Welcome to the Trader's Journey. In today's video, we'll uncover the most common mistakes that traders make and how you can avoid them to keep your profits on track. Brief overview. Whether you're a beginner or a seasoned trader, it's easy to fall into traps that lead to losing trades. But don't worry, we'll provide actionable tips to help you avoid these mistakes and improve your trading performance. Mistake 1. Overtrading. The biggest pitfall. What is overtrading? Definition: overtrading happens when you take too many trades, often due to impatience or fear of missing out. Why it's a problem. This can lead to burnout, emotional decision-making, and poor trade management. How to avoid overtrading. Stick to your trading plan and strategy. Set clear entry and exit signals and wait for the right setups. Example: don't trade because the market looks exciting. Wait for confirmation. Mistake 2. Lack of risk management. What is poor risk management? Definition: many traders fail to calculate proper risk-to-reward ratios, or they risk too much on a single trade. Why it's a problem. Without proper risk management, a single losing trade can wipe out several gains. How to avoid this mistake. Use stop-loss orders to limit your losses. Calculate position sizes based on your account balance and risk tolerance. Always aim for a risk-to-reward ratio of at least 1.2. Mistake 3. Ignoring trading psychology. What is trading psychology? Definition: the emotions and mental state you experience while trading, such as fear, greed, or overconfidence, greatly impact your performance. How it affects your trades. Letting emotions control your decisions can lead to impulsive trades, revenge trading, and excessive risk-taking. How to manage emotions. Recognize emotional triggers such as loss aversion or chasing profits. Take regular breaks to reset your mindset and keep emotions in check. Tip: start with a small position size to reduce emotional pressure. Mistake 4. Not following a trading plan. What is a trading plan? Definition: a trading plan is a comprehensive strategy that outlines your goals, risk management rules, trading setups, and how you'll react in different market conditions. Why not having a plan is dangerous. Without a plan, you're more likely to make emotional decisions, get caught in impulsive trades, and lack consistency. How to avoid this mistake. Develop and stick to a clear trading plan before you execute any trade. Keep your plan simple but flexible. It should cover risk limits, trade criteria, and trade execution rules. Mistake 5. Trading without patience. What does trading without patience mean? Definition: this mistake happens when you force trades, get impatient with setups, or fail to wait for confirmation. Why it's harmful. Impatient traders often end up in bad trades, resulting in higher losses and missed opportunities. How to avoid this mistake. Practice patience and wait for the perfect setup. Don't trade just for the sake of trading. Make every trade count. Mistake 6. Not learning from mistakes. Why it's important to learn from mistakes. Mistakes are a part of trading. What matters is how you learn from them. How to learn from your trades. Keep a trading journal. Track your trades, emotions, and mistakes. Review past trades to identify patterns and avoid repeating the same errors. Mistake 7. Not adapting to changing market conditions. Why adaptability is crucial. The market is dynamic, and successful traders must be able to adapt to changing conditions. How to stay flexible. Use a combination of technical and fundamental analysis. Be open to adjusting your strategy depending on market behavior. Conclusion. Summary. So there you have it, the most common mistakes traders make and how you can avoid them. By managing risk, following your plan, and staying disciplined, you'll increase your chances of success in the Forex market. Call to action. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more tips and strategies. Let me know in the comments what trading mistakes you've learned from and how you're working to avoid them. Have you ever found yourself in a trade only to feel that rush of panic the moment the market moves? Maybe you've second-guessed your decision, hesitated before executing your next move, or even pulled out too soon, only to watch the market bounce back. You're not alone. Fear is something every trader faces at some point. But what if I told you that understanding and overcoming that fear could make all the difference in your trading journey? Welcome to today's video where we'll be diving into the psychology of fear in trading and exploring effective strategies to overcome it so you can trade with a clear, calm mind and make better decisions. Section 1. The Psychology Behind Fear. Narrator. Fear is a natural human response, hardwired into our brains for survival. Thousands of years ago, fear kept us safe from predators, activating our fight-or-flight response when danger was near. But in the world of trading, fear can trigger irrational decisions, panic selling when the market dips, or missing out on opportunities because of doubt. When fear takes over, it can cloud our judgment and make us react impulsively. And it's not just the fear of losing money. Many traders also experience FOMO, or the fear of missing out, when they see others making profits. There's also the fear of regret, where you second-guess yourself after making a trade, thinking about what could have been. Understanding these fears is the first step in overcoming them. Fear in trading doesn't just affect beginners. Even experienced traders face it, especially when the market becomes unpredictable or highly volatile. Section 2. Practical techniques to overcome fear. So, how can we conquer this fear and trade with confidence? First, let's talk about acknowledging and accepting fear. The key here is recognizing that fear is a natural part of trading. It's not something to be ashamed of or avoid. In fact, acknowledging it allows you to separate the emotion from the decision. Rather than allowing fear to control you, you can choose to take a step back and regain perspective. Next, it's crucial to develop a solid trading plan and stick to it. Fear often arises from uncertainty. Having a clear plan with defined entry and exit points gives you the confidence to stay the course. No matter what happens in the market, your plan remains your guide, helping you avoid emotional, reactive decisions. Third, focus on risk management. One of the biggest sources of fear is the potential for loss, but when you manage risk effectively, you'll feel more secure in your decisions. This means using stop-loss orders, determining the right position size, and setting realistic profit goals. When you're not worried about losing everything in one trade, your fear diminishes. Another effective strategy is to practice mindfulness. When you feel fear creeping in, take a moment to breathe deeply and clear your mind. You can even incorporate brief breaks throughout your trading day to reset mentally. It's also helpful to keep a journal, reflecting on your emotions during trades so you can identify patterns and detach from them over time. And finally, try to reframe fear as excitement. What if, instead of seeing fear as something negative, you embraced it as a sign of opportunity? The nervous energy you feel can be turned into motivation to refine your strategy and approach. Reframing fear helps you remain calm and focused instead of letting it control your actions. Please comment below for the next topic. We will try to create videos according to your interest. Section 3. Real-life example or case study. Let me share a real-life example of how fear can affect even the most experienced traders. Take the case of insert trader name or example, who faced significant losses early in their career due to fear-driven decisions. They would panic during market downturns and hesitate when opportunities arose. Over time, they learned to accept their fear, creating a robust trading plan and following strict risk management principles. Slowly, they gained control over their emotions, eventually turning fear into a source of motivation. Today, they're more disciplined and less prone to impulsive decisions, showing that fear doesn't have to control your trades. It can be managed and turned into a valuable asset. Conclusion and key takeaways. So, to recap, fear is a natural part of trading, but you don't have to let it rule your decisions. Recognize it, accept it, and use it as a stepping stone to better trading. Develop a solid trading plan, manage your risks, practice mindfulness, and reframe fear as excitement to keep your mind focused on the long-term goal. Now I want to hear from you. How do you handle fear when it pops up in your trading? Drop a comment below and let's share strategies for overcoming it together. Thanks for tuning in, and remember, the more you understand and manage fear, the better you'll become at navigating the markets with confidence and clarity. Don't forget to like, subscribe, and hit the bell icon for more trading insights. Until next time, trade smart, stay calm, and trust your strategy. What if I told you that you could win less than half of your trades and still make money? Today, I'll show you how, with a real XOSD example, the right mindset, and a habit that can change your trading forever. Part 1. The low-risk, high-reward principle. In this example, we have a total of 20 trades with a 2-to-1 risk-to-reward ratio. Out of these, 8 trades are winners. Each winning trade makes $60, so 8 multiplied by $60 equals $480 profit. The remaining 12 trades are losses. Each losing trade costs $30, so 12 multiplied by $30 equals $360 loss. To find the net result, we take $480 profit minus $360 loss, which equals $120 net profit. This shows that even with only 40% of trades winning, you can still end the month in profit if your risk-to-reward ratio is in your favor. The math works in your favor, but only if you stick to the plan. Part 2. Why holding until SL or TP is crucial. Here's the problem. Many traders sabotage this math by closing early. You see price plows 40 pips in profit, and you close. But your plan said plow 60 pips. You've just cut your potential reward. Or you move your SL further away because it might reverse, and instead, you lose more. The mindset shift. Your job isn't to win every trade. Your job is to let your winners run and keep your losses small. The edge comes from consistency, not prediction. Part 3. Journaling. The mindset weapon. Most traders ignore. After every trade, write down pair traded and direction, buy, sell, entry price, SL, TP, reason for entry, technical, fundamental, emotions at entry, confident, anxious, revenge trade, etc. Emotions during the trade, final result and pips gained, lost mistakes to track, closed before TP, moved SL, overtraded after a loss, took a trade outside of strategy rules. Why it works psychologically. Builds self-awareness. You start spotting emotional patterns. Turns trading into a data-driven process, not an emotional roller coaster. Forces you to review and learn instead of repeating mistakes. Closing mindset. Takeaway. Winning in trading isn't about being right all the time. It's about managing risk, trusting your plan, and learning from every single trade. With the right R, the discipline to hold to SL or TP, and a solid journal, you're already ahead of most traders. The Psychology of George Soros. How to manage risk like a pro. Welcome to today's video, where we uncover the psychology behind one of the most famous traders of all time, George Soros. Known for breaking the Bank of England, Soros' approach to trading and managing risk is an essential lesson for all traders. Let's break down how Soros not only mastered the markets, but also the mindset required to take calculated risks. Who is George Soros? George Soros is best known for his $1 billion profit by shorting the British pound in 1992. This move earned him the title of the man who broke the Bank of England. But Soros is not just a trader with deep pockets. He is a master of understanding financial markets and human psychology. In fact, his trading strategy is rooted in his belief that the market is driven by human perceptions and not just economic fundamentals. The psychology of risk management. Soros is a firm believer in the importance of managing risk. In his own words, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Soros is willing to take large risks, but only when the reward outweighs the potential loss. This mindset is crucial in trading psychology, where emotional impulses often lead to reckless decisions. Lesson 1. Control your emotions and stick to your plan. The key to Soros' success lies in his emotional discipline. He has the ability to control his emotions during periods of market volatility. When most traders panic, Soros remains calm, executing his strategy based on thorough analysis. If you want to be successful, avoid chasing short-term wins and focus on executing your plan despite market noise. Lesson 2. Be willing to cut losses quickly. Soros once said, "I'm only rich because I know when I'm wrong." This is a crucial aspect of his psychological approach to trading. Soros is quick to cut his losses, a lesson that many traders fail to adopt. Emotional attachment to a trade can cause you to hold on to losing positions, hoping for a reversal. However, successful traders know when to admit they're wrong and move on to the next opportunity. Conclusion. George Soros' psychological mastery of risk management and his emotional discipline have made him a legend in the trading world. The lesson here? Embrace risk, but manage it wisely, cut losses early, and stick to your strategy. Trading is as much about psychology as it is about the markets. Remember, your mindset can be your greatest asset or your biggest liability. The psychology of Jesse Livermore, overcoming the fear of losses. In this section of the video, we'll look at the life and trading psychology of Jesse Livermore, known as the Boy Plunger. Livermore made, and lost, millions in his lifetime. His story is not just about making the right trades, it's about overcoming emotional barriers and fears that could have otherwise destroyed his career. Let's dive into how Livermore overcame his psychological struggles to become a legendary trader. Early life of Jesse Livermore. Jesse Livermore's story is one of highs and lows. He was born in 1877 and started trading at the age of 14. His initial success was driven by his ability to read the market, but it wasn't long before he experienced significant losses. Despite his setbacks, Livermore continued to refine his strategy, and he eventually became one of the most successful traders in history. The fear of losses. One of Livermore's greatest challenges was dealing with the fear of loss. In his early years, he would often close out positions too early, fearing that the market would go against him. Over time, he realized that this fear was not rational. It was his emotions sabotaging his decision-making. To overcome this, Livermore developed the habit of sticking to his trading rules and ignoring the noise around him. Trading with confidence and patience. Livermore was known for his patience. He understood that the market moves in waves and that every opportunity isn't a perfect one. Successful traders don't rush into every trade. They wait for the right moment. In Livermore's case, it was his ability to wait for the market to confirm his analysis that made him successful. Lesson 2. Handling emotional roller coasters. Livermore's career was an emotional roller coaster. He experienced extreme highs of success and deep lows of failure. The key takeaway? Livermore taught us that managing the emotional highs and lows is just as important as understanding market trends. He advocated for a calm and detached mindset, which allowed him to continue trading without letting his emotions control him. Conclusion. Jesse Livermore's legacy teaches us that trading psychology is everything. Overcoming the fear of losses, maintaining patience, and staying emotionally disciplined in the face of uncertainty are all vital traits that successful traders must develop. If you can master your emotions, you can master the markets. The psychology of Warren Buffett, building patience for long-term wealth. Today, we're exploring the trading psychology of Warren Buffett, one of the world's wealthiest and most respected investors. Buffett is known for his long-term investment philosophy, which is rooted in patience, discipline, and an unwavering commitment to his strategy. But how did he develop this mindset? Let's break down the psychology behind Buffett's approach to building wealth over time. The Buffett approach to long-term investing. Warren Buffett's investment strategy revolves around the concept of long-term value. He famously says, "Our favorite holding period is forever." Instead of focusing on short-term market fluctuations, Buffett looks for companies with strong fundamentals and a clear path to sustainable growth. But the real question is, how has Buffett developed the patience to hold on to investments for decades? Lesson 1. Patience is the key to success. Buffett's greatest psychological strength is his patience. In a world of rapid trades and instant gratification, Buffett remains calm and allows his investments to grow over time. He's not swayed by daily market movements, and he doesn't get caught up in market hysteria. By remaining patient, Buffett can take advantage of the compounding effect that grows his wealth year after year. Lesson 2. Confidence in your strategy. Another lesson from Buffett is the importance of confidence in your strategy. Buffett's approach is based on thorough research and understanding of the businesses he invests in. This allows him to remain confident in his investments, even during times of market turmoil. For you, the takeaway is simple. Do your research, trust your strategy, and don't let market noise cloud your judgment. Emotional control in times of uncertainty. Buffett's emotional control is legendary. While other investors panic during recessions or bear markets, Buffett uses these times to make smart investments. His ability to separate emotions from decision-making allows him to buy undervalued assets when fear dominates the market. Welcome to the Trader's Journey, where we dive deep into the psychology behind trading. Here we focus on mastering the most crucial aspect of trading, your mindset. We'll guide you through the journey of overcoming losses, developing resilience, and learning from the world's most successful traders. If you're ready to transform your approach and thrive in the markets, this is the place for you. Trading isn't just about charts, strategies, and indicators. It's about mastering your mind. Today, we're diving into how to build the mindset of a successful trader. Whether you're just starting out or looking to level up, these tips will set you on the right path. Segment 1. The importance of mental toughness. A successful trader doesn't just follow the markets, they follow their own discipline. Mental toughness is one of the most important attributes in trading. It's not about how many trades you win, it's about how you handle the losses. The truth? Losses are inevitable. How you deal with them determines your success. It is said, "The market is like the ocean. You can't fight it. You have to learn to flow with it." Tip 1. Expect losses as part of the journey. Remember, no one wins all the time. Successful traders embrace losses as learning opportunities. They don't let a bad trade derail their entire mindset. Segment 2. Patience. Patience is key. While some may rush to jump into trades, successful traders know that waiting for the right opportunity is what sets them apart. Patience is bitter, but its fruit is sweet. Aristotle. In trading, this couldn't be more true. Waiting for the perfect setup takes patience, but when it pays off, it feels incredibly rewarding. Tip 2. Master the art of waiting for the perfect setup. Patience doesn't mean inaction. It means waiting for your edge. It's about controlling your impulses and waiting for a clear signal from the market. Segment 3. Self-discipline. Successful traders stick to their rules. Whether it's risk management or sticking to a trading plan, discipline is a non-negotiable part of the process. Discipline is the bridge between goals and accomplishment. Jim Rohn. Tip 3. Stick to your trading plan. A clear trading plan helps you avoid emotional trading decisions. Set rules for entering, exiting, and risk management, then follow them no matter how tempting it might be to break them. Successful traders follow the plan, not the market. Tip 4. Don't chase the market. Chasing after every potential opportunity leads to emotional decisions. Learn to be selective about which setups you trade. Segment 4. Managing Emotions. One of the most challenging aspects of trading is managing emotions, especially fear and greed. These emotions can easily cloud judgment and lead to impulsive decisions. The market does not care about your emotions. Tip 5. Control your emotions. Recognize your emotional triggers and know how to detach from them. Trading with a clear head will help you stick to your plan, even when things get chaotic. Segment 5. Consistency. Success in trading doesn't come from making huge gains in a single trade. It comes from consistently following a consistency is key. The one who is consistent will always outperform the one who is lucky. Tip 6. Focus on consistency, not perfection. Perfection doesn't exist in trading. The goal is consistency. By following your rules and sticking to your plan, you'll build long-term success. Segment 6. Learning from mistakes. Mistakes are a natural part of the learning process. Successful traders use their failures as stepping stones toward better decision-making. The greatest glory in living lies not in never falling, but in rising every time we fall. Nelson Mandela. In trading, your mistakes can become your most valuable lessons. Tip 7. Learn from your mistakes. Every trader has faced losses, but the difference between amateurs and professionals is the ability to learn from their mistakes. Analyze what went wrong, make adjustments, and use that information to improve. In conclusion, building a trader's mindset takes time, practice, and self-reflection. It's not just about the strategies you use or the tools you have, it's about how you approach the game mentally. Start with small steps, be patient with yourself, and keep evolving. Quote, trading is not about being right. It's about being disciplined and having a solid plan. Unknown. Remember, trading is a marathon, not a sprint. Keep working on your mindset and success will follow. If you found this video helpful, don't forget to like, subscribe, and leave a comment with your own tips for building a strong trading mindset. Happy trading. Welcome to our channel, where we take you through the journey of a successful trader. Our goal is to help you understand the ups and downs of the trading world so that you can avoid common mistakes and make your path to success easier. In today's video, we'll share the journey of Alex, a fictional Forex trader whose story is full of lessons that can help you navigate your own trading journey. Forex trading involves significant risk and may not be suitable for all investors. The information provided in this video is for educational purposes only and should not be construed as financial advice. We strongly recommend that you seek the advice of a professional financial advisor before making any investment decisions. Past performance is not indicative of future results, and trading in Forex markets can lead to substantial losses. Only trade with money that you can afford to lose. Please trade responsibly. This is also not a channel to teach you any strategy or edge. It will teach you something that no YouTube channel teaches you. It tells you about the real pain a trader has passed through and the journey of a successful trader. The struggles. Alex started his trading career full of optimism and excitement. He thought with the right strategy, technical analysis, and price action, he could easily conquer the markets. But, like so many new traders, his early days were full of mistakes. He faced losses again and again, often driven by FOMO, fear of missing out on every opportunity. It felt like the market was constantly slipping through his fingers. For the first couple of years, Alex was fighting a battle of frustration. Every time he lost, he promised himself it would be the last time. He would swear to stick to his plan, to be disciplined. But as we all know, it's easier said than done. We all make rules, and sometimes we swear by God to be disciplined, but still end up breaking them. Why? Because we haven't mastered losing. As human beings, we don't want to lose. It's not just about money. It's about pride, ego, and the overwhelming desire to avoid failure. And that's what led Alex to break his own rules time and again. The big loss and the internal battle. Then came the turning point. One night, after another losing streak, Alex found himself staring at the screen, overwhelmed by frustration. His emotions were running high, his mind clouded by the need to recover the losses. In a moment of weakness, he broke his rules and entered a trade that didn't align with his strategy. Within minutes, the market moved against him. His heart sank as he watched the numbers on his screen flash red, and in that moment, Alex realized he had just made the same mistake again. As the loss mounted, Alex felt a deep sense of regret. But this time, it wasn't just about the money. It was about his failure to follow through with the discipline he had promised himself. He sat there in shock, asking himself, why did I do this? Why can't I just stick to the plan? He felt defeated, but more than that, he felt human, a trader struggling with the very instincts he was supposed to control. In that moment, Alex understood something vital. The market wasn't the enemy. It was his own impulses, his need to recover quickly, and his fear of losing. The real battle wasn't with the charts or the market. It was within himself, and the hardest lesson of all was learning how to lose gracefully. The turning point and a hard lesson. Alex sat up that night and promised himself that things had to change. He spent hours reflecting on his mistakes and realizing that to succeed, he had to embrace losing. Not just accept it, but master it. He knew that trading wasn't about avoiding losses. It was about managing them, controlling the emotions that came with them, and moving forward without breaking his rules. He understood that every trader goes through this internal battle. We all want to win. We all want to be right. But the true mastery in trading isn't in never losing. It's in how we handle those losses. And that was the lesson Alex had to learn the hard way. Success. After mastering discipline. From that moment on, Alex approached trading with a new mindset. He stuck to his strategy and made a promise not to chase losses. He allowed himself to accept that losing was part of the game. Slowly, his losses became smaller, and his wins began to feel more consistent. Each win wasn't a reason to become overconfident. It was just proof that his plan was working. And when the losses came, he didn't let them define him. He learned to let go of the regret, stop fighting himself, and move on. With time, Alex's discipline strengthened. The battle wasn't just about following a plan. It was about fighting his own impulses, embracing the process, and trusting that with patience, the profits would come. Advice to viewers. Now Alex's advice to all of you is simple. The market isn't your enemy. It's just numbers, data, and patterns. But you, the trader, are the one who can make or break your success. Don't let your emotions control your decisions. Avoid revenge trading. Don't double up on losing positions and always stick to your plan. The true battle in trading is not with the market. It's with yourself. Mastering loss is a key part of mastering yourself. The market will always have ups and downs, but it's how you react that makes all the difference. Embrace the loss, learn from it, and don't let it control your next move. Conclusion. Alex's journey shows us that success in Forex trading is built on mastering your own mind. The hardest part isn't understanding the market. It's understanding yourself, your emotions, and your impulses. So don't be like Alex when he was chasing the market. Learn from his story, avoid the mistakes, and stay disciplined. Stay grounded, trust your strategy, and always remember, the road to success in trading starts with mastering your emotions. You're capable of becoming the trader you've always wanted to be. In this video, you'll hear the fictional, but emotionally real, story of Midrarula, A new trader who spiraled into losses, only to discover the hidden battle within his own mind. Inspired by Mark Douglas's The Disciplined Trader, this is not just a story about money. It's about fear, failure, self-reflection, and ultimately, the journey to becoming a disciplined trader. A young man, Midrarullah, in his late 20s, clean-cut, glasses, sitting in a dimly lit room with a glowing laptop. Charts on screen, soft music playing. A photo frame in the background says, "Freedom." Quick cuts, account balance rising from $5,000, $6,800, celebratory coffee. He told himself, "I was made for this." Midrar smiling confidently. Twitter screen with a guru yelling, "Breakout alert." He, clicking, buy quickly, showing no analysis. The first loss. The next morning, the stock gapped down. Screen turns red. 22% flashes. Midrar frozen, sweat on brow, eyes wide. His account now reads $4,300. Clock ticks late into the night. He scrolls, clicks impulsively. Revenge trading spiral. He started revenge trading. Screens show minus 15%, minus 30%, $2,100 loss in minutes. Midrar's desk becomes messy, hair disheveled. He rubs his face. The breaking point. He asked himself, "What am I doing?" Midrar sits alone in darkness. He stares at the screen, hollow-eyed. His reflection in the screen is warped and ghost-like. Enter Mark Douglas. He searches trading psychology. A book opens virtually with the cover, "The Disciplined Trader." A quote appears on screen like a whisper. The market is neutral, and you just have to trade without emotions, reflection and realization. He making panicked trades, biting nails. He looks at himself and sees a younger, more desperate version of himself. The rebuild begins. He stopped trading. He closes the laptop, walks outside for air. He reads the book, makes notes. Whiteboard scenes. Rules appear. Maximum risk 1%. Journaling each trade. No revenge trades. Following rules in any cost. New approach to the market. He didn't chase. He didn't force. Places one trade with calm, then closes his laptop. Green candle rises slowly, but he doesn't cheer. He smiles subtly. The disciplined trader emerges. He stopped needing to be right. He started journaling in a quiet room. A wall has the quote, "The consistency you seek is in your mind." He rejects a risky trade alert and logs into a planned setup instead. But the market is no place for fantasies. Losses come like unexpected storms. Confidence shakes. There are sleepless nights, whispered doubts, and that aching question, "Am I really cut out for this?" The struggling trader tries harder, clicks faster, takes revenge on the charts. But the market remains silent, indifferent. Because it's not the charts that need changing, it's the mind behind the mouse. Then comes the breaking point, not with fireworks, but with silence. A pause, a decision, to stop chasing, to start learning, to face not just the market, but yourself. So begins the real transformation. Rules replace impulses, risk is respected, journals replace blame. The trader becomes still, deliberate, disciplined, no longer needing to win every trade, just to follow the plan. And one day, without notice, profit appears not just in numbers, but in peace. This is the journey, from chaos to calm, from ego to execution, from struggling trader to master of self. Because in the end, trading was never about the market. It was about you.